2017 webinar series. This year's theme is Creative Solutions, Our Concepts, Your Clients. Each month, we'll focus on stories of your clients spanning through various generations. We'll explore plans for your professionals starting on their careers, newlyweds and growing families, small business owners, and soon-to-be retirees. We'll show you how we carefully crafted risk management strategies to help your clients enjoy life in the moment. This month, we'll explore and create effective plans for clients who are insurance challenges. Each month's series will last about 50 minutes, and you must be logged on the full 50 minutes to receive CFP credit. And since timing is everything, please ask questions as you have them by typing them in. We'll do our best to answer them as they come. Today's webinar is being recorded and will be posted to our website within a week in case you missed it. And throughout 2017, loyal fans will receive 9 CFP credits, one for each month. Today's presenter is knowledgeable in a wide range of solutions here at LLIS. He's constantly monitoring the insurance and financial services industries to ensure your clients are getting the most up-to-date recommendation. He joined LLIS in 2003 with his CFP and MBA and has been writing the LLIS story as president and CEO since 2013. And now, Mark Maurer.
Thank you, Taylor, and welcome everybody to our October webinar. And I hope that it's a little cooler wherever you are than it is here in Tampa. Yeah, it's getting still warm. So as we're approaching Halloween and all kinds of scary things this year, let's talk about sometimes some scary insurance challenges. And so we're going to cover a number of topics today. Some you may be a little familiar with. One or two that I think might be brand new for a lot of you that sometimes can be a little scary. So some kind of run-of-the-mill insurance challenges. I wanted to talk a little bit about premium financing. Might not be familiar to many of you, but it's to me one of the scariest things out there that I see. Let's talk about conversion on term coverage and why it's important. How to prevent scary surprises. On Halloween, I think it's the only night that sometimes you like to be scared when you walk by that house and the wolf man jumps out from behind a bush. That's about the only time that we really get excited about surprises. So when you're going through the insurance, being able to disclosing it all is important and helps prevent some of those surprises along the way. Let's talk about inherited annuities. And this is just as you have clients more and more, you're going to have clients who come to you who inherit annuities, and just things that you need to know when your clients ask you, what should I do? And let's talk about some owner and beneficiary changes so that how to do it correctly so that we don't create any surprises along the way. But those first insurance challenges. One of the questions I get regularly is well, how do we ensure a stay-at-home parent? Now, they're stay-at-home. If any of you have stay-at-home parents in your life, they don't really stay at home. They're busier than the rest of us. They're going back and forth everywhere. You can't say non-working. They work harder than the rest of us. So parents at home, if something were to happen, I love this slide because this is the stereotype of what would happen if mom wasn't there. Dad can't even figure out how to wash the dishes without flooding the house. Now, maybe not to that extreme, but a little bit, that's a little bit true, because the stay-at-home parent does so many things for the family. And this sheet goes through a little bit of the housekeeping, facilities manager, teacher, driver, laundry operators, computer operator, janitor. So a stay-at-home parent provides a lot of things that, even though they're not earning an outside income, if we had to replace that person, it's going to cost us, and this says it's about $118,000 a year. It's going to take a lot of, it's going to take some additional capital and cash to be able to hire people to do those things so that the working parent can continue to earn their income. And so one of the questions I'm asked is, well, if someone doesn't have any income, especially a stay-at-home, work-at-home parent, they don't have any outside income, how much coverage can we get? Well, the normal rule of thumb there on the left is dollar for dollar of the coverage on the employed parent up to, I know some of you have already done it in your head, $1 million, or up to 50% of the employed parent. So there is a monetary value that insurance companies agree that even though someone isn't working, that the loss of that person has an economic impact to the family unit. So coverage for non-employed parents, that's about a general rule of thumb. So I think some people think because they don't have any income, you can't get life insurance on them. And so there's a general guideline. How about sports figures? Besides what you see in the paper, a lot of them are pretty normal. You know what? They need term life insurance as income replacement in case they were to die while they're in their earning years. Well, and where they may not be exactly like the rest of us is that they may be higher amounts, higher incomes, and many times you have shorter term periods because many of the rest of us might work till 60, 65, 67, whatever Social Security retirement age is. If you're a football player, by the time you hit 40, they start talking about how old you are. So you have shorter term periods to earn large incomes. So sort of like the rest of us, just different. If you're a really good sports figure, then you probably have estate tax issues. Actually, if you're a good sports player and have talked to a good fee-only financial planner who's helping you not blow all that money on fancy cars. So you may have estate planning issues. Another option for this is to fund while that income is high today. Again, income is maybe very short, and so in the ideal world, you fund all of those retirement goals, all of the estate planning goals, all of the things that you want to do for them for the future while there's income coming in the door. It's much easier to divert money towards planning when income's coming in the door than when it's not coming in anymore. You say, we still need to fund all this. With what money? With what income? So many times it's a shorter time to get all of these things funded, but their income is high. What about disability? And we talked about death, but what if they become disabled? Then that's a different arena. The specialty lines or Lloyd's of London policies. I think we normally think of Lloyd's of London as covering Tina Turner's legs and sort of kind of outrageous things. But for the most part, we work with advisors and their clients to cover sports figures. We've helped baseball players, professional golfers, and Lloyd's of London can just be for high income people. I think the most recent ones we've done on specialty lines have all been physicians. They're all making over $1 million each. And it's this income that's high. They could be sports figures too. But those are things, again, that require, they're not normal people making $100,000 or $150,000 a year. So you have those options to cover those outliers. Let's talk about high net worth clients just for a minute. When I think of high net worth clients, I tend to think of estate and estate tax planning. Everybody needs estate planning. Not estate tax planning, estate planning. Estate planning is just simply, how do I pass on what I have at death to my survivors, my beneficiaries? Even if you just have a house and an old Ford Pinto, you have estate planning because you have to figure out who to leave that to. Now, high net worth clients, now we may also have estate tax issues and estate tax planning involved. So we look at second to die life insurance policies. Because the estate tax isn't due until a second death, that's why these life insurance policies were created, so that the death benefit is there to help with estate taxes at a second death. And an important thing is to get this life insurance out of your taxable estate. If you have a $5 million policy in your taxable estate and you die, well, that just increased your taxable estate by $5 million. So it's important to have somebody else own it. And it can be an irrevocable life insurance trust or an ILIT. It's a separate entity. There's a trustee. Or you can have children own this policy, sometimes called the poor man's ILIT. Either way, it's owned by somebody else. Now you have to think, are the children responsible? Are they old enough? Could they inherit $1 million, $2 million unfettered, or do we need the protection of the trust? Those are details, but the idea there is estate or estate tax planning. And hybrid long-term care planning. You have high net worth clients, and on the face of it, they could self-insure. Self-insure just says, I'm going to use some of my assets if I need to pay for long-term care. But why would you use up $500,000 of assets if potentially you could put away $100,000 or $150,000 of assets to pay for the same thing? So with the hybrid life long-term care policies, you're reallocating money to a different pool. It still has a cash value. There's a death benefit if they die and never need it for long-term care, but if they need it for long-term care, there's a much bigger pool. It creates much less exposure to using down all of the other assets. Same thing with the hybrid annuity. What's neat about the hybrid annuity is that you can cover two spouses on one policy. So both spouses, partners, can be eligible to receive long-term care benefits from the annuity. And if they never need it, it just has annuity cash value. So it's annuity at the core. So neat ideas for people who could self-insure, but if they can, why not reallocate some of their other assets into something that gives them more protection? Now, if you do have high net worth clients, they may be approached by this guy. Now, if I saw him coming, I think I'd be a little creeped out. But what he wants to talk about is premium financing. Ooh. Let's do that again. I had fun with that. Ooh. So let's talk about premium financing just for a minute. And for the background, there's 3 parties required for some premium financing. First, you need an insured. You need a person who the life insurance is going to be on. There needs to be an agent who is proposing this to a client. And there's a lender who is going to finance the premiums. Now, some of you are probably saying, well, especially with the ooh spooky voice, why would anybody ever want to do this? Well, most of the time they don't have the ooh spooky voice, which would be really good tell, kind of like in a movie when you hear the scary soundtrack coming, you know something bad's about to happen. It would be great if we had those when anybody ever talked about premium financing. But why is somebody interested in this? The promise is that there's going to be free life insurance involved in this. That's what's attractive. That's why people do this. And it's because it's being approached to them by somebody saying, you're a high net worth, here's something that probably all other high net worth people you know are doing. So how does it work? Well, the agent, and here Pennywise, approaches a client and says, let's talk about a way to get you some free life insurance, maybe for estate planning, maybe to leave it to your beneficiaries. So all you have to do is take a loan. Okay, so you're going to take a loan from the lender. With that loan, you're going to pay some premiums into the life insurance policy. So you have to take a life insurance policy out on yourself. You took a loan, you're going to pay the premiums in a life insurance policy. Sometimes it's proposed that down the road you're going to take money out of the life insurance policy, and this is usually an indexed UL policy that projects market-like returns. So someone down the road, you've put in all this money, you're going to have all this even bigger pool of money a few years. You're just going to take money out of there to pay off the loan. Okay, that doesn't sound bad. Or a no-lapse guarantee UL or GUL, guarantee UL. And these sometimes are a death benefit return of the loan. So I took out a X dollar loan. Whenever I die, X plus interest is like a collateral assignment or a lien against the life insurance. And so whatever's left over after paying back the loan from the life insurance goes to my beneficiaries. Still, none of this sounds that bad. Okay, I take out a loan, I buy life insurance, and there's going to be something left there for most of it's going to pay off a loan. Some goes to my kids. Okay, that doesn't seem that scary yet. And so you do all of that. Sounds pretty easy. I think I explained it in a minute or two, and you can get some free life insurance. The problem is, this is still true today as it was when somebody said it, nothing in life is free. Even most things are free, require you to go get them or sign up for to be on an emailing list to get something free. So nothing's free. For example, if we look at an indexed UL, you're going to pay the lender back with the cash values. That's great. But you're not ever really shown, or maybe it's not ever really disclosed or explained that this policy has 15-year surrender charges, maybe even 20. So how exactly do you get access to all that money to pay off the loan? Well, and this loan is going to keep growing. Indexed UL, variable UL, any policy that has cash value accumulation, whole life with dividends, anything like that is based on a projection of growth, which probably will, but if it's an index UL, the markets can go up and down, may not. But that loan, that is growing. So we have a loan that we know is going to increase, but cash values that are projected to grow, but we're not sure that they will. So you have a loan that we know is growing and cash values that we hope are growing. So if any of you are reading between the lines here and with what I'm talking, you can probably imagine where we're heading. And about 6 weeks ago, I had an advisor and CPA come to me with this scenario, and I mentioned that I might use it in a webinar because all of that sounds really good, but this is the 8 years later, where is it now? If you say you take out this loan to have some life insurance, when you die, the life insurance pays off the loan, and then the remainder goes to your kids. It's free life insurance. It's hard to say that doesn't sound good. It does, but let's see what happens. Lucy was 75 when her agent Jack approached her, and he said, "Hey, Sparky, let's apply for a $16 million policy. Sounds great. And here's what we're going to do. I've got this lender friend, and you're going to take a loan for an initial premium of $2.5 million. I'll stop that. You all are probably worried about me. Take out this loan for $2.5 million. You're high net worth. You can afford it. You're going to take this loan. It's going to be collaterally assigned to you. You're personally liable for it. Don't worry about that part. So take this loan, and you're going to put that $2.5 million into this $16 million life insurance policy. And you know what? It's going to carry it for a while. And you're not going to pay anything for the next 8 years. And then I feel like if I could say this in small print, that would be great. And then you're going to pay premiums of $455,000 a year for 20 years. But nothing's going to happen for the next 8 years. And then you have to pay premiums for $455,000 for 20 years. But again, nothing for 8 years after that, that $2.5 million loan that you took out. And so you have this high net worth client. They can take the loan. So, there is enough money in they have enough assets to take this loan. So, there is nothing that's hurting them. And they say eventually you're going to pay back the lender. And whether it's with a death benefit or with the cash values, eventually, you're going to pay back the lender. and you're going to have this remainder of free life insurance. Again, everything's still sounding pretty good. Now let's fast forward 8 years. Lucy still has her $16 million life insurance policy. That $2.5 million loan has grown to $6.5 million. I would like to have been this lender. Couldn't, probably don't have that kind of money to lend anybody, but hey, I made almost $4 million in about 8 years. That's not too shabby. So, these are the sorts of things that they didn't really pay attention to for a while. It was based on the swap curve plus 1.5%. You know what? I don't really know what that means. I am sure that Lucy didn't know what that means and doesn't know what it means. All I know is that I'm really glad my mortgage is not on the swap curve plus 1.5%, because that's $4 million of interest after 8 years. So, yeah. And so now, 8 years later, Lucy is personally liable for a $6.5 million loan. This is part of what I think people forget. It started off as $2.5 million loan. Maybe that was reasonable based on her net worth at that time. 8 years later, her estate, if something were to happen to her, there's a $6.5 million loan outstanding. Right now, there's the life insurance still, but she is personally liable for that. And I think that sometimes that's sort of forgotten. But now it's time to keep paying these new premiums, and the new premiums are supposed to be financed. They're supposed to be borrowed against. She doesn't want to pay the premiums out of her own pocket, and she doesn't want to pledge further liquid assets against the additional premiums needed to take more loan. So it's that 8 years, everything was hunky-dory, and now it's showing up almost $500,000 of premiums or loans need to be taken out. And so she's understandably a little bit worried and concerned about this. So what are her options 8 years later? Well, one thing we're helping explore is a life settlement. And a life settlement is the sale of a life insurance policy to an institutional buyer. What's not helpful here is that Lucy's still healthy. Even though she's now 83, she's still in good health. Her original policy was issued at preferred plus rates. And there's nothing that says, she's had any health changes. So life settlements are valuable, or particularly valuable when somebody was issued at good health and has a diminished or shortened life expectancy. The institutional funders also traditionally don't like premium finance. Why? Well, it was sort of sold initially for not a significant real use. It wasn't necessarily for estate planning or recommended to do anything other than get some free life insurance. And if I'm a life settlement funder 8 years later, and all that had gone in was the $8.2 million, $2.5 million, and I bought the policy for 2.6, you might say, hey, that's pretty good. I got my money back. How much is Lucy probably looking for today? $6.4 million, enough to cover all of that loan. So as a potential buyer, the number that somebody's looking for is going to be so much higher, so it may not be particularly attractive. What if she surrenders values? Just, can I surrender this policy, get rid of it, and pay back the loan? Not with $79,000. That's the cash surrender value in this policy. That won't cover this year's interest. Can she reduce the policy face amount? So one question was, can we reduce the policy from $16 million to some lower amount and not pay any future premiums? Well, we can. The question is going to be, is it enough to cover the loan? And it's not looking like it. We're already working on getting some in-force illustrations there, but we think that we're going to have to reduce the policy down farther than where the loan is today, and that doesn't cover any any potential future loan growth either. So when somebody approaches your client about premium financing, the first part looks really good. Remember Lucy's story 8 years later of how it can go wrong. Almost everything has to go in the right direction for it to work out. When one little thing hiccups, the cash values don't grow as high, but the loan keeps growing. All those little things are like snowballs rolling downhill. A little tweak here and there could cause big problems later. So run, don't walk when your clients are proposed these. But you know who this did work out for? Well, the agent has sold a policy, probably about $460,000. That was probably about the commission paid on a $16 million universal life policy. That lender has made $3.9 million on a $2.5 million loan in 8 years. You know what? So far, the lender and the agent are made out pretty well. It's Lucy who's not. And oh, by the way, as they started looking into this, and the CPA and the family advisor trying to work this out, the entrusted agent who sold the policy is no longer with the brokerage and is nowhere to be found. So don't leave your clients out in the cold. Don't ever let them get to be out in the cold like Jack here. If you see premium financing, remember, don't walk, run, to prevent any scary premium financing stories. So next topic I want to talk about is conversion. And what would Halloween be, month of October, Halloween be, without talking about vampires? Well, here's pre-vampire Brad Pitt. And you know what? He's doing everything right. He's listening to his family non-vampire financial planner and has some income, wants to protect it, and gets a $1 million 20-year term policy. And he says, I like this. Look at him, pretty young. I'm in my income earning years. I'm going to probably work about the next 20 years, earn my income. And then, I hope I don't need it. But if I do need it, then, I remember hearing that term policies are convertible. So life's going along pretty good for Brad Pitt until, oh, darn it. You know what? 17 years later, he's turned into a vampire. And he's thinking, oh, this stinks. But you know what? I need to keep some life insurance, because I'm sure that's the first thing you think about when you get turned into a vampire, is about your life insurance and your term insurance. And so he says, oh, but at least I have that term policy. And he says, oh, no problem. I have that term policy. It was going to stay level for a while. And then he says, what? My premiums are going up? So he's not that happy. And he says, okay, well, now that I do look at it, I remember it was for 20 years. So initially he's mad. But he says, let's convert the policy, that term policy, because now that I'm undead, I need this policy to go on pretty much indefinitely. We call it age 100, age 121, but I really need to keep this going. This term coverage isn't going to work. And so he looks down at his policies, and as he's going through it, he takes a look. Well, we're glad it wasn't the policy that has no conversion option. Some term policies out there have no conversion privilege. What's conversion? Conversion is the ability to exchange your term policy for permanent coverage with no underwriting, no health, no financial. So had pre-vampire Brad Pitt been a preferred plus non-smoker, he could convert his term policy to a preferred plus non-smoker universal life, whole life, variable universal life, whatever that insurance company has available for conversion. And even though now he's a vampire and basically uninsurable, the insurance company issues the new policy at a preferred plus non-smoker rate class at his now age. So if he got it when he was 35, now he's 48, it'd be as if he has a 48-year-old super preferred universal life, whole life policy. So it's important to have a conversion option. Granted, most of your clients are never going to turn into vampires, but clients do get Parkinson's. They can get Alzheimer's. They can get cancer. They can have strokes. They can have things that diminish their life expectancy, and they want to be able to keep some life insurance coverage. If there's no conversion option at year 21, the premiums just start going up and up and up. And there's no option really to do anything else if you want to keep that policy. Some term policies aren't convertible for the full term period. They say it's a convertible term policy. However, some companies have a 20-year term policy that's only convertible for 10 years. So halfway through a policy, you have to make a decision. I bought the policy when I was 35, I'm 45. I'm still in good health, and I can keep my $400 a year premium or start paying $3,500 a year to convert it to whole life. I'll keep the term. 10 years down the road, say you got turned into a vampire. You already passed your conversion option. It's gone. So no conversion option, half a conversion option aren't things that we recommend. We recommend that the conversion is there for the full term period on the term policy, because you want to know that it's going to be my 20-year term policy exactly as it is. But when I get to the end of the 20 years, when I get to the end of that premium that I was planning on, if something has happened, then I know that I can trade my term policy for permanent coverage without any underwriting if my health has declined, because that's when you want to convert the policy, not halfway. You don't want to keep paying the ART premiums every year. You want to know that conversion is there when the term period is up. Now, how do we prevent insurance surprises, scary insurance surprises, like when you're out there trick-or-treating and people jump out from behind houses or behind cars at you? Let's look at Kurt. He's age 38, and he applied for $1 million 20-year term policy with us. And based on the information he disclosed to us in his application interview, we quoted a preferred non-smoker rate of $694 a year. As part of the life insurance process, most insurance companies want you to do a paramed exam. They'll do a blood sample, a urine sample, take your height and weight, ask you some health questions. Not all of them do, depending on the different amounts, but in Kurt's case, he did. And what you can see here is a lab tech taking a look and saying, well, we're going to approve him at a preferred smoker rate because he has nicotine in his system. And nowhere on the application or the application interview did he admit to that. So we went back, talked with Kurt, and he says, I don't know. Yeah, I don't know how that got in there. Tobacco and nicotine? Nope. No idea. I really don't know. Oh, wait. Sometimes at work, I go outside, like in the afternoons when some of the guys at work go out for a smoke break. So that must be how I have nicotine in my system. Well, here's the underwriter, sort of shaking his head, putting his hand over his eyes, going, oh boy, if I had a nickel for every time I heard that. But you can't test positive for nicotine from secondhand smoke, from hanging out once an afternoon with people who are smoking. So we politely sent that information to the underwriter, and the underwriter politely told us that. So we went back to Kurt again, and he said, oh, huh. Well, I chew nicotine gum, when I'm feeling stressed at the office, a couple pieces a day. So would that be considered tobacco or nicotine? I wish I had the picture of me, sort of shielding my eyes, shaking my head. Um, but yes. So that does. Um, and so where we'd applied for a preferred non-smoker rate and set up that expectation, he was approved at a preferred smoker rate of $2,464 a year, because most insurance companies, if you test positive for nicotine, they are going to give you a smoker rate class. There's nicotine in your system. They can't really verify how it got there, especially when you don't mention it at all. And so the surprise and the scariness and the challenge here was that that's a big difference in premiums. Had we known, there are some companies who give non-smoker rates for people who use cigars, chew, dip, nicotine gum. So how to prevent scary insurance challenges like this is to remind your clients to disclose everything. If we know about it, we can find the best fit. If we don't know about it, then sort of like this, we have to do more work, which we don't mind, but your client isn't happy because it keeps going. You're not happy because it keeps going. So, we like to do things the first time. Like I tell my kids, haste makes waste, do it right the first time. So we'd prefer to set up that realistic expectation the first time and then keep going. Our next topic is inherited annuities. And here we have Norman and Norma. And you know what? Norma passes away. And she leaves her son, Norman, $450,000 of annuity values, annuity death benefit. So Norman, understandably, is pretty excited about that. And so he says, okay, great, $450,000. It's a death benefit, so it's going to be tax-free, right? I know life insurance, when it pays a death benefit, it's tax-free. So an annuity death benefit's tax-free too, right? Well, it's not. And so this is why we're going through this is because even though it's called a death benefit and it's on an annuity, which is an insurance policy, it's not life insurance. Life insurance death benefits are income tax free. Annuity death benefits are not necessarily tax free. So annuities, he's got one option when he inherits this annuity is to just take it as a lump sum. And there's $450,000 of annuity death benefit. And there's a $200,000 cost basis. His mom had put in $200,000 of after-tax money into this annuity. So where I said not necessarily taxable or tax-free, when you inherit an annuity, and this is a non-spouse, spouses can continue annuities on as their own, sort of like an IRA, but most of the time kids inherit annuity, and the kid will pay tax on the gain. So in this case, the cost basis was $200,000. The annuity death benefit is $450,000. There may be a death benefit rider. That may just all be gains. Either way, the inheritor is going to pay ordinary income tax on the gains. So if you take a lump sum, Norman's going to get a 1099 for $250,000 this year. And that's going to bump him into a few different tax brackets. Well, a little maybe more exciting. And there he is going, yay! It's not really yay, but yay! We can annuitize this over his lifetime. And so it's going to pay him $20,000 a year for the rest of his life. For the first 45 years, part of it's going to be non-taxable, return of basis, so it spreads out the basis over that period of time, and it spreads out the gains over that period of time. So for the rest of his life, he'll get $20,000 a year. And as time goes on, the basis is used up, and after 47 years, all of that $20,000 is taxable. All that $200,000 basis has been amortized out, basically. Well, somebody sees $450,000 in a lump sum today, or $20,000 over my life. The $20,000 over life isn't that exciting, really. Option number 3 is you can stretch the payments out over 5 years. And the IRS says you can take it as a lump sum, or distribute it all within 5 years, or pay out over lifetime. When you keep it as an annuity and just take withdrawals, just simply taking money out, it's still a withdrawal from an annuity and gains come out first. So for the first 2 years, assuming no growth, it's $450,000 divided by 5. Those first 2 years, the whole $90,000 he takes is 100% taxable. In year 3, most of it's taxable. In year 4 and 5, it's all tax-free. So there's $250,000 of gain. As he takes withdrawals, all the gains come out first. Probably better, the number 1, because it's not all taxed in 1 year, but that still can bump him into some different tax brackets with all of you're still weighted with the gains initially. But there's a number 4, a super secret option, and this is to annuitize over 5 years. So when we could annuitize over his lifetime and do that over, and it spreads out the gains and spread out the payments, could also annuitize it over 5 years. Different than withdrawal, you're actually putting into an immediate annuity and annuitizing over 5 years. And so what this does is it spreads out the gains and the basis over 5 years. So $440,000 over 5 years, there's his basis. There's the basis over those 5 years. $53,000 a year, which is taxable as ordinary income, but over 5 years. So it's like spreading it out of the lifetime without spreading it out over 40, 50 years. So it's 5 years. It's a really neat option that usually isn't included in any of the claims packets. So you have to know to call us to ask for it. So you have the options. You can take the lump sum, pay tax, do anything with the money. Annuitize over his lifetime. Gains are spread out over his lifetime, which is probably a good thing, but that $20,000 doesn't seem all that exciting. Or you can stretch payments out over the 5 years, but all the gains come out first. Or the super secret option. For the most part, anybody who has a sizable gain, any advisors ever mentioned this to clients and we've been able to help with, anyone who has a sizable gain has always gone with number 4. Some people may have a $450,000 annuity with a $425,000 basis. The spreading the gains out over 5 years for $5,000 a year isn't worth it to them. But that's a neat option. But remember, it's irrevocable. Once you choose if somebody chooses the lump sum payment, it's done. It's set. Time expires. You have periods of time. If you wait 3 years and then try to annuitize it over 5 years, well, that's a total of 8 years. So you can't do that, and most insurance companies don't have a 2-year immediate annuity. So it's important that when this thing happens, talk to somebody soon to get all the pieces set up. And because, you know what, if your client inherits $450,000 annuity from his mom, he may say a boy's best friend is his mother. And our last, still a little creepy. Some things are just always creepy. Last thing we're going to talk about are owner and beneficiary changes. And a little bit of Scooby-Doo, a little bit of Jessica Fletcher, Murder, She Wrote thrown in here. So some of the things and questions that we get asked are about changing beneficiaries, changing owners, who should be beneficiaries. Well, one of the things when we look at ownership changes or making beneficiary changes is that if it's a trust, only the owner can make changes, which may make sense. But if there's a trust and there's a trustee, no matter if Mr. Smith paid the premiums, set up the trust, funded the trust, applied for the life insurance on his life, has done all of that, and if the trustee is George Costanza, only George Costanza can call the insurance company and make any changes. Only George Costanza can update anything. Change beneficiaries. So sometimes people set up trusts really and may not understand the full impact of having something completely separate. In order to be completely separate, like an irrevocable life insurance trust, it has to be completely separate from the person who gave it. Make sure there's a bank account in place. Somebody may have a policy on their life and set up a trust and then move a policy into a trust. We had an example of somebody who, an advisor and clients who we tried to help, and what they'd done is they'd done exactly that, set up some trusts, moved policies in and around, and they'd tried to take a withdrawal. Well, they had a withdrawal and it was made out to a trust. Well, nobody had ever set up a trust bank account. And so we tried to help this advisor and the client go through that process of what they needed to do. It's also important to have up-to-date trust and trustee information. My trustee probably shouldn't be my great-granddad because I'm probably going to outlive him. So, things like that. Think of who the trustee should be so that hopefully they're around when you aren't. Changing beneficiaries. If you change a beneficiary to an individual, most insurance companies are going to require their social security number and address. And part of this comes down to being able to file the taxes down the road. I think there's some Patriot Act things involved in there too. If there needs to be sort of an odd change for a divorce decree, it's good to have the divorce decree there. Maybe you need to have an irrevocable beneficiary for part of a policy, which says you can't cancel a policy or make any changes. This person has to be named, and if the policy lapses or they want to surrender it, you have to let the beneficiary know. And I don't believe that minors should be named as beneficiaries of policies. They can't open bank accounts, they can't collect the money, and so naming a minor we don't recommend it. The lack of, without a trust or some other establishment going to guardians, then I think the estate under the will of, in my case, Mark W. Maurer, gets the money to my estate and then money is passed out through my will. So let's take an example here of Shaggy, who had a policy through us. Unbeknownst to us, he called the insurance company directly and renamed his beneficiaries. Didn't let us know, didn't let his fee-only advisor know, just called, had it changed. And I'm guessing he did that because not too long later he passed away. And so to his daughter, who was of age, $250,000 of the $750,000 policy went to her. And to Scooby-Doo, say it's his son, weird-looking son, but his son, $250,000 went because he was also over age 18. Scrappy-Doo, or the minor, can't open a bank account, can't receive money. And so the insurance company is still sitting on $250,000 that they are trying to pay out for the benefit of Scrappy-Doo. While it's sitting there, it's earning interest, so that's a good thing. But about every 6 months, the insurance company is contacting everybody they can find. They've already contacted the siblings to say, is there somebody who's named as a guardian? Is there somebody who can help establish a bank account so that this money can go to help pay for and care for this Scrappy-Doo? And every 6 months, nothing seems to happen. So eventually what will probably happen is that because the siblings, there's no guardian, nobody involved is trying to move this along, they'll probably sit there until Scrappy-Doo's 18. But the insurance company keeps trying to pay it out. So remember, who are you going to call? Call our policyholder service team. Claudia, Neva, Ashley. If you've got crazy ghosts or beneficiary ownership changes, one of the two, call them because that's what they do. They're here to help. If you change the beneficiary to a trust, or if a trust is named as a beneficiary, make sure that there's a bank account in place. because the trust, if somebody dies and the trust is the beneficiary, there needs to be a trust bank account established so there's a place to pay the money. Now, you have a tax ID number of a trust, this stuff, that things that should be set up initially so that if somebody does pass away, then there's a place for the life insurance to be paid to. Again, making sure there's up-to-date trust and trustee info is important. Because let's say you're Jessica Fletcher, and one day your husband Frank passes away. Well, Jessica's going to get a death claim packet. And within the death claim packet, there's going to be some things that she has to send in to verify this. Certified copy of the death certificate, the trust pages, because in this case, her husband Frank named a trust as the beneficiary of his life insurance policy. And with that, how does money tend to be paid from a life insurance policy? 3 or 4 options. Some are pretty straightforward, I think, that we're all familiar with. Maybe some of that maybe we aren't. Well, first is a lump sum check. If it's $1 million policy, $1 million plus any interest that's accrued gets paid somewhere or wired somewhere. It's probably what we all think of, sort of straightforward. 2, settlement options. On page 17 and 18 of a life insurance policy, probably the stuff that nobody really reads, it describes different settlement options. So if there's $1 million life insurance policy, you have different options on how that can be paid out. It can be deposited interest, sort of sit there like a savings account. You can have just the interest paid. It can pay fixed installments. The death benefit can be paid out in fixed payments over 20 years. You have life income options. Pay me the $1 million like it was an immediate annuity over, guarantee it for my lifetime. All of these are options in the life insurance policy in those pages 17 and 18. You can even set them up, the policy owner who takes out the policy can even set those up at issue. If you know that somebody's a spendthrift, you can make sure that it's paid out over 10 years or 20 years. Maybe give some flexibility, but not so that somebody gets $1 million unfettered. So those are things that are just neat to know. There's a direct access account. Basically, it's a checkbook. You have an account, you can wire money from it, you can write checks from it to pay for things, pay for Aunt Irma to come in from Alaska for the funeral. So lump sum check is usually if you know exactly where you want to go. Settlement options, you know you don't want to get it all. Direct access account, I don't know what to do with it right now. I'm not sure what I want to do with $1 million, but here's a checkbook that lets you pay for the stuff you need. You don't have to decide what to do with other accounts. You don't have to decide where it goes. Do I pay off the mortgage now? Do I do whatever? You don't have to decide. You use your direct access account. So it's a really nice option there too. So during the claims process, like I said, it was determined that Frank had named a trust as a beneficiary, but Frank had never created a trust bank account. Well, he was the only person who was named as the trustee of this trust, so how can he set up an account for this trust when he's the only trustee and he's passed away? So it took a while, and we helped out this client and this advisor. It took about 3 months. It took a court order. It took a lot of work and an attorney and a claims specialist at the insurance company to try to get this all resolved. And insurance companies want to pay this out. They're trying to figure out how to do it. So, but he couldn't open a bank account for the trust because the trustee was deceased. So it took about 3 months, and eventually Jessica gets the death benefit plus interest, but it took about 3 months, and it was stressful. So, that's the kind of stuff that we're trying to avoid. So if you're working with a client and they're going to name a trust as the beneficiary or trust as an owner, make sure there's a trust bank account there so that it can be set up now while everybody's alive. And have a happy Jessica Fletcher instead of the surprise Jessica Fletcher. So keep the beneficiary info current. We'll do policy reviews for you and your clients to help make sure that those are things that are there. Contingent beneficiary is important. If you have a contingent beneficiary, then if the primary beneficiary is deceased, it can go somewhere else. I recommend no minor children. Know the trust information and make sure that's all set up too. There's what's called a collateral assignment. So many times you recommend clients contact us because they're taking out a loan for a small business loan, taking out a loan for something. And they need to name the bank as, they say, a beneficiary of the policy. It's not really the beneficiary. They're naming the bank as, they want the bank to be able to pay back the loan. So this is what's called a collateral assignment. So let's take Jessica Fletcher's kids, or nephew, Grady and Donna. Grady buys a business and he takes out $1 million life insurance policy because he takes out $1 million loan to buy this business. He pays down the loan to $600,000 and then horribly passes away. When you have $1 million life insurance policy and put a collateral assignment on it, what happens is at death, the insurance company goes to pay out the $1 million death benefit. And the claim specialist is working through and they say, or not but I see there's a collateral assignment to the bank. So that's the first place I go, and they're going to call the bank and say, bank, I see there's a collateral assignment. And the bank says, yes, we gave Grady $1 million loan, but he's paid it down to $600,000. So the insurance company is going to pay the bank $600,000 for the balance of the loan. And Donna is actually named as the primary beneficiary. So she's named as the primary beneficiary of the policy. There's a collateral assignment attached to it like a lien. So what happens is the insurance company is going to take a look at the collateral assignment, contact the lender, whoever the assignee is, and say, is there still a debt owed? They'll pay the remainder of the debt and then pay the primary beneficiary the remainder of the life insurance. Let's say Grady paid off the $1 million loan. Then the insurance company is going to go to the collateral, forgets to take off the collateral assignment. It's going to go to the assigner, to the bank, and the bank's going to say, oh, he paid off the loan. He doesn't owe us any money. And so the insurance company is going to pay to the primary beneficiary. Why you don't want to name the bank as a primary beneficiary? Because when you set it up, the bank, he owes the bank $1 million. So you name the bank as the primary beneficiary of this policy. If he dies, even though he's paid the loan down to $600,000, the insurance company doesn't know this. The insurance company is going to pay 100% of the benefits to the primary beneficiary. So $1 million goes to the bank. So now you have to work to undo that. You have to get the money out from the bank to the spouse, in this case, Donna. It could even potentially be taxed because it looks like income. So again, ways to prevent distress. If a client says, I need to name a bank as a beneficiary for a loan or something, know that it's a collateral assignment. We can help with that. So here's a few things we talked about. Insurance challenges, premium financing, inheriting annuities, owner and beneficiary changes, and premium finance. Ooh, stay away. We have 2 more webinars. It's one of the things that makes LLIS different. If you haven't worked with us before or listened to one of our webinars before, we have in November, because November is long-term care month, and December, talk about the end of the year policy reviews. What are some more things about LLIS if you're not familiar with us? Well, we're not your competition. Our only clients are fee-only advisors. So we work hand in hand with fee-only advisors to help find the best fit when it comes to insurance. Do our best to save advisors time and your clients money when they need insurance. We do a lot of pre-underwriting to avoid surprises. Remember Kurt? Had we known ahead of time about the nicotine gum, we could have steered him to that $900 a year policy instead of having to go up to the $2,400 route policy and then back. There's a number of pieces of information for advisors and clients on our website. We're proud sponsors of a number of different fee-only financial planning groups. And I will be at the NAPFA conference in Orlando. Wow, is that next week already? Come on down to warm, sunny Florida. We have specialists in life insurance, disability insurance, long-term care insurance, annuities, and hybrid long-term care policies with life or annuity benefits. And when your clients get insurance through us, we keep you in the loop with our AIM system. And this year we're going to be launching our LLIS, our new website that can offer a number of different things for advisors, up-to-date views of clients' policy statuses, existing policies, annual statements. So stay tuned. I'm very excited about this. And so I close with any questions. I hope everyone has a safe and happy, healthy Halloween. There's one question. You mentioned triggers like losing weight. If a client has been rated for type 2 diabetes and loses a bunch of weight, how long does that have to be documented before an insurance company will underwrite the client more favorably? Good question. The insurance company is going to look for something that shows it's got to be documented. And so usually 12 months is the right amount of time. Most insurance companies on their application ask, in the last 12 months, have you gained or lost more than 10 pounds? So what they're looking for is somebody who doesn't crash diet for 2 or 3 months to try to get a better life insurance rate and then goes right back or even more. So 12 months is usually the period of time. And like I said, it should be documented. You want to see that last October, they went to the doctor and they weighed in at a lower rate. And today, when they have their paramed exam, it has the same build or even better. So they're looking for some of that. With diabetes, additionally, you want to make sure that their A1C and their blood work is coming back more favorably too. For the most part, most people, if they lose quite a bit of weight, that's going to improve. But you have those two pieces for the type 2 diabetes. All right, well, thank you, everybody. I have a few more questions coming in, some about the CFP, some about other things. So I will get back with all of you individually here in the next week. And thank you again. Hope to see many of you at the NAPFA conference. And thanks for attending.